So let me just give the audience a few tips to look out for when you're evaluating deals. Starting with what Dennis just said, when you look at the T12, which is the trailing 12, this is what the property was what it was performing at the last year. And you look at the year one pro forma, which is what the operator is projecting. And you look at the rent and look at the net operating income. If there's a huge difference, that's a red flag. If the property was making $1 million last year and they're projecting like making $1.3 million in year one, unless this is first of all, see, even a stabilized asset, you wouldn't see that. You wouldn't see such a huge jump, particularly in a value add and strategy. There's so much turnover, and even if there wasn't, you don't want to underwrite little turnover. So when you have a lot of turnover, you cannot count on the rent being collected, and so therefore you should not see a big jump in the NOI. Okay, so that would be red flag number one for me. Number two is looking at what they're projecting for rent growth. And especially right now with the recession looming, you don't want to see 10, 20, 15%, unless they can really, certainly it warrants a question mark. You ask the operator, how do they come up with this 15% when we have a looming recession, right? So number two. Number three, look at the expenses. Make sure that the expense ratios are properly projected throughout the years. When you see enough of these deals, you'll get a feel for what they should be. And obviously every market's going to be a little different, but it's somewhere between 35 to 50% of the revenue. And again, if something looks off, just ask the operator and see how they answer. And that's how they answer the question is also pay attention to the that's another clue that you're going to have. Another one would be, this is a really big one, reversion cap rate. Okay, so this is the cap rate in which the operator thinks that they can exit the property at. The cap rate is essentially the inverse of a PE multiple. So when you play around with stocks, oh yeah, if this is a high growth company, you're willing to pay a richer premium or richer valuation. You're willing to pay a higher PE, right, for the stock because it's supposed to grow like crazy. In properties, there's the inverse, and it's called cap rate. And so the lower the cap rate, the more valuable that stream of cash flow from the property is. And so one trick that an operator can do is to make that reversion cap rate, which is the valuation that they think that the property can exit at. If they artificially reduce that number, they're basically saying that they can get out at a much higher multiple, right? And so just a small change is enough to make the deal look really good on paper. So the question to ask the operator is, what are you using for reversion cap rate? How does that compare to historical averages? And ask and see how the answer comes. Sometimes it's really obvious. This number is clearly too low, right? But if the number is on the higher side and it's still projecting a nice R and equity multiple and yada, yada, so on and so forth, then that's an example of a conservative underwrite.